Years after 100, long life and best wishes for your digital age.
In spite of this long history, the Manila Times has not wavered, is not wavering, and will never waver in bringing the truth to its readers, in taking a big part in nation building.
The long-term vision for the Manila Times remains the same basic, steady driving force that has been motivating the management and everyone down the road to work hard toward making that dream a reality. And that is to bring back its glory as the media institution that has been
and the following sponsors for making this event possible: Air 21, Century Properties, FWC Life Insurance, iFranchise Business Services, Sharp Philippines, Vine Holistic Medical Aesthetics and Wellness Spa. Plus, we'd also like to thank our special partners, Cross, Ibarra Manila, and our official radio partner, 91.5 WIN Radio or WIN Radio. We would like to request all our members, participants, guests to please move over and come inside the ballroom. The program will start in a few minutes. Thank you very much.
The Manila Times welcomes you all as we celebrate the 120th birthday of this grand dame of Philippine journalism. Having evolved through the changing, challenging times, Asia's must-read English language newspaper always believed in quality over quantity. As such, it has been introducing new special sections that it deemed important to the readers, to whom it has the duty to tell the truth. The Times has continued upholding the highest standards of journalism in news gathering and putting out special reports. For years, its commentary section has remained strong at #1. Even the business and lifestyle sections have been reformatted to cater to the growing number of readers who have shown sophistication in their reading stable. The Sunday Times has also undergone a redesign. And there are more special sections such as Boardroom Watch, Build and Design, Golf, Campus Press, Lookbook, Stockwatch, and Sunday Business. You may look forward as well to an annual special magazine dedicated to the companies at the top rungs of the corporate ladder. This will be launched before the year ends. The paper's website is also up for a relaunch with additional sections and a new cutting-edge design. Another addition to this growing family is a mobile application called the Manila Times Correspondent.
This new mobile app will allow Filipinos to become citizen journalists and allow them to report to through the Manila Times what is going on in their part of the country.
The Manila Times also feels that its duty is to train the younger people wanting to become journalists. Yes, the paper wants to inspire the younger breed to aspire. This media company has therefore continued to strengthen the curriculum of TMTC, or the Manila Times College. Already, the school has been working closely with the Manila Times Television, or TMTV, for an internet streaming news service. This has been complementing the video content and live streaming coverage that the Manila Times offers.
Today, the digital path looks ever more imperative as the way of the future. It would be irresponsible for a news company to move into the future without going digital. We cannot afford to be left behind in the multimedia race.
Manila Times, in the meantime, have this to say to their favorite daily.
Of course, I like reading the Manila Times because it's part of my daily coffee routine. And I find that the Manila Times reports the news in a straightforward and in a concise manner. And I love the different columns that you have.
I love, for example, the business section coming from the Chamber of Commerce of the Philippine Islands. And I love the sports section, the entertainment and lifestyle section. I guess being the oldest newspaper in the country, you have all these records on what the news was in the last 120 years. So that part I love.
Not only is the Manila Times good with your coffee and morning read, it also does help develop the Philippine society.
Good morning once again and welcome to the Manila Times 8th Business Forum. We would like to thank the following: our co-presenters for today, Mega World and New San Jose Builders, the official venue, Marriott Hotel Manila, and the following sponsors for making this event possible: Air 21, Century Properties, FWD Life Insurance, iFranchise Business Services, Sharp Philippines, Vine Holistic Medical Aesthetics and Wellness Spa, plus our special partners, Cross, Ibarra Manila, and our official radio partner, 91.5 Win Radio. We would like to request everybody to please stand for the Philippine National Anthem and remain standing afterwards for the opening prayer.
Our Father, who art in heaven, hallowed be thy name. Thy kingdom come, thy will be done, on earth as it is in heaven. Give us this day our daily bread, and forgive us our trespasses, as we forgive those who trespass against us. And lead us not into temptation, but deliver us from evil. Amen.
Okay, thank you very much. We would like to request everyone to please settle down, sit down. And at this point, we would like to call in our President and CEO of the Manila Times. Let us now listen to the welcome remarks of Dante Klink Ang II.
Distinguished guests, delegates, ladies and gentlemen, good morning. On behalf of the Manila Times, welcome to today's Business Forum on Investments. As you probably heard us explain before, the Times organizes these events to enable you to hear from the experts directly. We consider this part of our new mandate in the digital age, where we compete with social media, other information sources, as well as our traditional competitors who also have an online presence. We are committed to supplying better quality information that you need to make key decisions on business and other facets of life. We are driven by the need to go beyond our traditional role of simply informing our publics, which now also need to understand or get a sense of the world around us. Today, we hope to help you make a better sense of investments. In other words, our aim today is to add to the public discourse matters about our collective prosperity and well-being. In this case, there's much to sift through. Only yesterday, the Manila Times reported the assurances of the government that the future is bright despite the so-called headwinds. Finance Secretary Carlos Dominguez, in a speech, said that growth was to recover given the increases in foreign direct investments and in public spending. In the same speech, he mentioned the challenges: elevated inflation, a strong US dollar, and higher global oil prices. We have invited various experts to weigh in on these issues and on related economic development topics. So we hope that you find today's discussions relevant and useful. So here, allow me to step aside. I know you didn't come to, but allow me first to express my appreciation to all of those who made this event possible. To our co-presenters, Mega World and New San Jose Builders Incorporated, thank you very much. Our appreciation also goes to Century Properties, FWD Insurance, Business Franchise Services Corp., Shar Philippines, Vine Holistic Aesthetics and Wellness Spa, Air 21, and iFranchise Business Services. Our gratitude also goes to our special partners Cross and Ibarra Manila, as well as to our official venue Marriott Hotel and 91.5 Win Radio. Thank you, and may you all have a productive day.
Thank you very much. Thank you very much, Mr. Dante Klink Ang II. Again, ladies and gentlemen, we are glad that you could join us today for the Manila Times 8th Business Forum on Philippine investments, Ride the Growth Curve. I will be your host for today, Kim Bernardo Lokin. Our first speaker rose from the ranks at the Bangko Sentral ng Pilipinas, or the BSP, to his current position as Deputy Governor for the Monetary and the Economic Sector. He has been with the BSP for 40 years. Prior to his appointment as Deputy Governor in 2005, he was Assistant Governor for the Monetary Policy and International Operations. Earlier in 2001 up to 2003, he also served as Before then, our guest for today, for this morning, first speaker, he was the head of research at the Southeast Asian Central Bank Center in Kuala Lumpur, and this was in 1992 and up to 1994. Since 2000, he has been serving as co-chair with Bank Negara Malaysia's Assistant Governor for the CSAN Experts Group on Capital Flows. And in 2010 to 2013, the ASEAN Senior Level Committee on Financial Integration. The term 2016 to 2018 is his second term to serve as co-chair of the SLC. He also chaired the CSAN Task Force on CSAN membership. Our first speaker this morning graduated cum laude from the University of the Philippines School of Economics with an AB Economics degree. He also earned the Master of Science degree in Economics from the London School of Economics as a scholar of the Bangko Sentral ng Pilipinas. Ladies and gentlemen, let us give a warm round of applause for Honorable Diwa C. Gunigundo, Deputy Governor for the Monetary and Economic Sector of the Bangko Sentral ng Pilipinas.
That kind introduction. I wish it were shorter. Anyway, Mr. Dante Ang, the second, our editorial staff of the Manila Times, distinguished guests, ladies and gentlemen, good morning, and happy 120th birthday of the Manila Times. Baka pwede naman tayong pumalakpak. 12 years ago, the Philippines, through the Bangko Sentral ng Pilipinas, prepaid all of our external debt obligations to the International Monetary Fund. That was in December of 2006. And that very important event actually signified an end of an era, transitioning to a new one. That end of an era was characterized by a nation called the Philippines, one of the most or the highly indebted countries in the world at the time, in 2019, in the 1980s through the 1990s. Very poor output performance, high inflation, very poor fiscal accounts. Our external accounts were also in disarray in the 80s and in the 1990s. So people were referring to the Philippines as Asia's basket case. That was the old era. But we are now transitioning to a new era when we have already recorded 79 quarters of continuous, successive, positive economic growth since the first quarter of 1999. Inflation since 2002, when we shifted to inflation targeting, began to be more manageable, except this year. And I'm going to talk about that at length later on. Public finance since 2005 and 2006 started a turnaround after the president in 2005 declared the fiscal crisis. Since then, the government has been able to collect more taxes and therefore spend more, both on hard and soft infrastructure. Our external payments position also made a very significant turnaround. Since 2003, our current account position remained in surplus until 2015, 2016, when the economy's savings started to be less adequate to finance domestic investment because growth has been very robust all these years. The balance of payments was also in surplus since 2005 until 2015. So that was the transition to a new era. And since then, we have shed off what we called the boom and bust cycle that characterized the Philippine economy from the 1950s, 60s on to the late 1990s. And in line with the theme of this forum, I chose breaking the boom-bust cycle as the topic of my brief presentation this morning. The Manila Times, being in the newspaper business since 1898, has been a witness to the Philippine economy's journey, from doom to stardom of sorts, and its transformation from being previously dubbed as the sick man of Asia to being one of Asia's rising tigers. This is the nice transition from the old era to the new era. Boom and bust economic cycles are characterized by sustained rapid growth of the economy, that's the boom, followed by a period of economic contraction, that's the bust, seen through a general slowdown in economic activity, GDP growth, investment spending, capacity utilization, income and profits, among others. Ladies and gentlemen, recent data, as I have intimated earlier, would show that this is no longer the case for the Philippines, particularly in the last 2 decades. The first slide shows that contrary to the boom-bust cycle up to the late 1990s, the domestic economy has not registered any contraction or recession since the first quarter of 1999 up to the third quarter of 2018. That's 79 quarters or almost 20 years, even in the midst of crisis episodes, particularly during the global financial crisis of 2007 up to 2009. This sustained economic boom was even more pronounced in the past 6 years, 2012 to 2017, as the domestic economy posted an average GDP growth of 6.6% annually, making it one of the fastest growing economies not only in Asia, but also in the world. The sustained expansion of the domestic economy has been supported by broadening growth drivers, both on the supply side and on the demand side. With a sustained collaboration between the government and the private sector in enhancing the country's overall business climate, we are now reaping the dividends from strengthening further other major sectors of the economy, such as manufacturing on the supply side and private investments on the demand side. Now, based on the latest third quarter, by higher public construction and government spending on top of the usual growth pillars of household spending or consumption and private investments. Meanwhile, the growth in government spending, reaching 14.3% in terms of growth, reflecting 0.5 percentage points to the total GDP growth of 6.1%, since the highest since the second quarter of 2016. It's the weak net exports that actually pull down growth as exports continued to recover while imports remain substantial in the face of sustained economic expansion. The narrative is quite simple. The economy is now firing on all its cylinders, unlike in the past when some of the cylinders appeared stuck up. With the robust growth of the economy, this next chart, in the past 6 years and the 6.3% growth it posted in the first 9 months of 2018, the Philippine economy is expected to sustain its growth momentum for the rest of the year and in the next few years. Now, the series of favorable assessment of multilateral institutions in the first half of the year serves as proof. This is coming from the World Bank, the Asian Development Bank, and the International Monetary Fund for both 2018 and 2019. These third-party assessments are also not far from the national government's target of 6.5% to 6.9% for 2018 and 7 to 8% in the next 3 years. What are the key factors that lend support to the continued bright prospects of the, and this is by no means all exhaustive or all-inclusive. The first 25 years, this is the first factor, spent on dedicated pursuit of meaningful and purposeful policy and structural reforms is expected to continue to provide. There's a record from 1993 up to 2018, and there are still more policy reforms in the pipeline, particularly in Congress. Now, what are these numbers and words mean to us? It means that the government is proactively addressing bottlenecks in government services by automating procedures and processes, establishing online services, and improving public's transactional interface with government. These ongoing reforms are aimed at further reducing the cost of doing business here in the Philippines to be able to translate to a more competitive and productive business and workforce. This is the essence of what we are doing on a proactive basis, and this is to future-proof the Philippine economy. This is the first factor. Now, let me elaborate on this first factor. Our macroeconomic improvements supported by these structural reforms of 25 years have been duly recognized by credit rating agencies. Since 2010, the Philippines has received credit rating upgrades from the major global credit rating agencies, moving the long-term sovereign debt status from junk grade 8 years ago to investment grade. Now, this successive recognition of the country's heightening creditworthiness have undoubtedly cemented the Philippines' status as an economy with one of the brightest prospects globally. What are these numbers or letters telling us? The latest rating actions of the first 4 major international credit rating agencies, Fitch, S&P, Moody's, and RNI, keep the Philippines one notch above the minimum investment grade, or BBB minus. Meanwhile, the latest rating given by JCRA of Japan places the Philippines 2 notches above. The meaning of being in an investment grade status is that when the government comes out of the external capital markets, the spread to its external debt becomes tighter. So the cost of borrowing goes down, and because it's the sovereign debt that is the benchmark of private sector debt, so when private corporates borrow in the external capital markets, they will also benefit from tighter spreads. This is the meaning of being an investment grade. In the past, we were in the junk status, junk grade status, which means that we were paying 200, 300 basis points above Treasury. The Treasury is your benchmark, and then you have a spread of 200 or 300 basis points, so it's very expensive to borrow on the part of both the government or the sovereign and the private sector corporates. Second, we are not immune to external headwinds. I think Mr. Dantiang really quoted Secretary Dominguez saying that there are headwinds. We are not immune to those headwinds, but we are confident that we have strong buffers to maintain our own resilience. In a study done by the Center for Global Development, the Philippines was ranked as the most resilient country that will be able to withstand an economic crisis akin to last decade's Great Recession despite its status as an emerging market economy. 7 years before 2014, that was in 2007, we were rated number 7 most resilient. Number 1, I think number 1 was, well, of course, China, South Korea, and Chile. Okay, Chile was number 1, China was number 2, South Korea was number 3. 2000, and number 3 is China. CGD is a Washington-based research outfit. Of the 21 countries she studied, Rojas Suarez, the author of this study, ranked the Philippines as the most resilient economy. And the global financial crisis will not result in sharp contractions of economic growth, a severe decline in the rate of growth of real credit, and or the emergence of deep instabilities in the financial sector. Now, next one, next chart. Next chart. Reforms are positively recognized by independent third-party assessors like Transparency International, World Bank, Heritage Foundation, World Economic Forum. The country has indeed made important strides in enhancing its competitiveness over the past years. This has been demonstrated by the increase in rankings, as shown in this slide. The country's improved creditworthiness, exemplified by the country's elevation to investment-grade territory has undoubtedly cemented the Philippines' status as an economy with one of the brightest prospects globally. That is the first factor behind the bright prospects of the Philippine economy. And as validated and supported by those recognitions by third-party outfits. The second most important factor behind the bright prospects is that the government is working very hard to unlocking the growth potential of the Philippine economy through expanding further the economy in anticipation of the usual obstacles to sustain growth of middle-income countries, a phenomenon result of those 25 years of policy and structural reforms, as well as investments in hard and soft infrastructure. Current estimates using various methods indicate that our potential growth, what we are capable of doing, ranges now between 6.5% to 7%. And this is consistent with the medium-term growth target of 7 to 8% of the national government. Potential output simply means that we can grow up to 7% without going into what they call overheating, okay? Or severe strain on our resources, on the factors of production, for example. Now, the rise in the country's potential output has been attributed to the following. Number one, the recent climb in economic efficiency as indicated by the declining incremental capital output ratio. Please go back. Incremental capital output ratio. Second, improvements in total factor productivity. Thirdly, this slides at the bottom, which means that labor market dynamics have been favorable. We have a very young population, highly educated, highly trained. We have increased our the number of years for our students, K-12, and then we have the TESDA providing support to retooling or providing basic skills in different categories, providing additional support to the increase in our potential output. Now, these are the dividends from 25 years, as well as sustained investments in both hard and soft infrastructure, which I will dwell on in the next chart. So let's go to the next chart. To support the increase in the country's potential capacity, investments in both hard and soft infrastructures are given priority. This is the third factor behind the bright prospects of the economy. The government's strong commitment toward the implementation of its massive infra agenda, the Build program, is expected to raise the economy's growth potential even more. This is envisioned to generate an impressive multiplier effect on the economy, increasing its productive capacity, creating jobs, increasing incomes, and strengthening the investment climate, leading to sustained inclusive growth. In particular, these projects aim to decongest Metro Manila, for example, help improve regional connectivity, and ease the cost of doing business in the entire country. Now, this similar finding has been cited in the latest IMF Article 4 report on the Philippines, issued last November 10, 2017, whereby they said, increase in infrastructure and social spending, accompanied by increase in tax revenue and administrative reforms, will contribute to the rise of the Philippine economy's potential growth to 7.5% by 2022, given higher investments and gains in productivity and employment. So from 6 to 7, even the IMF is saying that by 2022, our potential output can even grow up to 7.5%. Fourth, keeping the country's inflation environment growth-friendly is a non-negotiable goal, especially for the BSP. We believe that the generally low and stable inflation, since the adoption of inflation targeting in 2002, has lent strong support to the breaking of the so-called boom and bust cycle of the Philippine economy. We see a manageable inflation environment as an enabling factor, supporting and promoting greater economic activity, even as we experience inflation upswings in recent months due to supply-side factors. In the first 10 months of the year, January to October, inflation averaged 5.1%. This is due to higher global oil prices, higher excise taxes, 18. The problem with the market, and to some extent some business reporters, is that they simply focus on the year-on-year. And they even rounded up, okay, the year-on-year inflation rate from 6.7 to 6.7. So September and October, 6.7, 6.7. But a more careful reading of the Philippine Statistical Authority's report on the October inflation rate puts it at 6.68%, which means there was a year-on-year decline in terms of inflation, the momentum, to 0.3. Okay? But again, the market would always say there's a need to continue tightening monetary policy. Inflation continues to be sticky downwards, etc., etc. But this chart would show the decline from 0.9 to 0.3, which means that in terms of its momentum, inflation is losing steam. Here, the one at the bottom says something about the results of the adoption of the interest rate corridor system by the Bangko Sentral ng Pilipinas. Our open market operations have become more effective in transmitting our monetary policy actions to the rest of the finance. That given the 150 basis points increase in the policy rate of the central bank until September, of course, this month, we put it by another 25 basis points for a total of 175 basis points, means the numbers will show that various market rates have already responded, and more than 100%. For example, the domestic interbank call loan, or IBCL, okay, is up by more than 100 basis points, exactly 156 basis points, from 150 basis points adjustment in the policy rate of the central bank. The benchmark 91-day T-bill rate has already increased by more than 200 basis points, which means that, again, the transmission from the policy rate of the central bank to the market rate, which is the benchmark 91-day T-bill rate, is more than 100%. We are therefore very careful to ensure that our monetary policy stance while addressing inflation issues will not unduly restrict the growth of the economy. After all, this is the mandate of the central bank. Promote price stability that is conducive to a balance of the Philippine economy. Next chart. Now, when we decide on monetary policy, we do not simply decide on the basis of the outlook or the projection, okay, inflation expectations, but we also make true that the upside risks are more dominant in 2019, next year. Downside risks are more dominant in 2020. But having said that, I think we can take a look at some of these important upside risks. The first upside risk is further transport fare hike. What can we expect? Oil prices are starting to go down. From a high of more than $80 per barrel, it has come down to just about $60, $61 per barrel. Therefore, the motivation for further petition for higher transport fare is not there. Second, higher electricity rates. If oil prices are coming down, again, the possibility is that utilities rates or electricity rates can also be adjusted downward. At the same time, one of the reasons peso is depreciating. But the peso is now appreciating. From nearly $55 to about 55 pesos to $1, now it's down to 52.50, even at this time that we are speaking. Okay. Thirdly, faster than expected monetary policies in advanced economies and geopolitical tension. In many instances, the Fed chairman, Jerome Powell, including the vice chairman and some voting members of the US Fed, have been saying, number one, our tightening of monetary policy in the US will continue to be gradual. Second, they have also expressed some concern about the possible slowdown, not only in the US economy as a result of two factors. One, the significant tightening since the taper tantrum of 2013, and second, the impact of fiscal incentives or fiscal stimulus is beginning to wear off. So now, the US Fed, through its different members in the US Fed board, are now expressing concerns of this possible slowdown in both the global economy and in the US economy. And therefore, the fear about faster than expected monetary policy may be addressed by those expressions of concern. Now, of course, what were the downside risks before we changed our forecast? One, we were expecting that the passage of the rice tariffication bill to migrate us from quantitative restriction on the imports of rice to a tariffied regime will bring down inflation by about 0.85 percentage point. And second, the temporary suspension of the excise tax on fuel will also further reduce inflation by 0.1 percentage point. So I think with this, while the upside risks, okay, may be there, and there are three of them, even if we add up the upside risks and the downside risks, I think we would still be on target in 2019 and 2020. So our forecast for 2018 is 5.3%, 2019 is 3.5%, and 2020 at 3.3%, against our target of 2%. Now, next chart will show that given that most of the drivers of inflation uptick in recent months are supply-side shocks, the economic team was quick to emphasize the need for non-monetary measures to complement the monetary policy actions pursued by the Bangko Sentral. And here we have a complete listing of that administrative order signed by the President mandating the implementation of these non-monetary measures. Okay? We are already seeing the potent effects of these non-monetary measures as shown by the significant decline in the month-on-month inflation of October 2000. Behind the bright prospects in the Philippine economy is the adequate buffers from global headwinds given its strong external payments position. And here we show, okay, the foreign direct investments continue to be robust. First 8 months of the year showed a 31% increase in FDI against a similar number in 2017. Remittances and BPOs bring in more than $50 billion every year. Our gross international reserves is about $75 billion, sufficient to finance 6.8 months of imports of goods and services. The rule of thumb is about 3 to 4 months. This number is also sufficient to cover our short-term debt based on original maturity 6 times and based on residual maturity 4 times. The rule of thumb is 100%. Okay? Ours is 600% and 400% relative to our external short-term external debt. And finally, our debt profile. Our external debt, okay, hit a high of nearly $80 billion sometime in 2011, 2012, to its present level of just about $72 billion. And relative to the gross domestic product, that's only 22.5%. In contrast, to more than 60% in 2005, 13 years ago. So we have more leeway, we have more flexibility in making use of our own resources instead of putting that to debt servicing of our external debt. The Philippines' external payments position remains manageable despite renewed deficit in both the current account and the balance of payments. Now, just to correct some of the misimpressions that we may have from the reporting of some business reporters about the current account deficit. It is important to understand that the narrowing of the current account is mainly reflective of the sustained, robust growth of the economy. As the domestic economy grew at an annual pace of about 6% over the course of the last 6 years, there has been a strong motivation for increased imports, particularly of capital goods, raw materials, and intermediate products. Over time, as investment-led economic activities result in the expansion of the economy's potential capacity, there can be subsequent rise in goods exports, eventually mitigating the current account deficit. This is what another sustainability factor is the stability and soundness of our financial system. A healthy financial system is crucial in ensuring a stable and sustainable economic growth. Basically, what we're saying in this chart is that the financial system continues to grow in terms of its asset growth. The loan portfolio continues to improve. Now, the non-performing loan ratio is less than 2% versus 2001's NPL ratio of more than 18%. Our banks continue to be profitable, and our capitalization is above global and BSP norms. The solo and consolidated capital adequacy ratio is between 15 and 16% versus the international standard of 8% and the BSP's regulatory capital of 10%. Now, while we emphasize that the country's macroeconomic fundamentals remain strong and the Philippine government continues to implement proactive measures to maintain our sound fundamentals, we recognize, however, that there are risky headwinds, okay? Both in the domestic economy, like infrastructure gaps, and in the external sector, like the uncertainty of the US Fed monetary policy action. So what's the outlook for 2018 and 2009? External payments account will continue to be manageable, and even in terms of exports and imports, we expect some improvements for 2000 and particularly for 2019. And we have sufficient buffers in the external payments position, particularly in terms of our reserves level. Now, moving forward, continue to address future agenda. I think we have to ensure that central banking continues to be relevant, that we need to contextualize ourselves in the fast-moving developments across the globe and across various sectors. And I'm going to just mention two. The first one is in terms of the fourth industrial revolution. Okay? We need to ensure that we can achieve our mandate of price stability, financial stability, and credible and efficient payments and settlement system, even in the context of the advent of the fourth industrial revolution. This is the rise of the digital economy. We believe that we can leverage on these digital innovations, fintech, cryptocurrencies, and use of blockchain technology or distributed ledger technology to promote more efficient and inclusive financial system. For instance, the responsible use of blockchain technology can serve as a tool in enhancing the third pillar of central banking, payments and settlement system. Regulators like the central bank is looking at fostering an enabling ecosystem where responsible innovations are encouraged to thrive. Leveraging on safe, innovative, and affordable financial instruments and channels can also drive business and industry growth and serve as the gateway to greater financial inclusion to millions of Filipinos who are outside of access to formal banking or financial services. That's the first agenda, challenge of the future. The second challenge is social equity. It is not enough that we talk about social equality. Social equality is simply saying we must level the playing field. I think we have to go beyond social equality and start talking about social equity. And this chart actually captures the essence of equity versus equality. Everybody watches the game. Okay? That little one, while having the same platform, is not able to see the games. That's social equality. But here we're talking about social equity, where everybody can watch the game. But that's only possible if that little guy is given 2 platforms instead of 1. Okay? The one in the middle can see the game, even if he maintains just 1 platform. And the tallest guy, even without the platform, can still watch the game. Now, we find relief that to a certain extent, a lot of the policy reforms that we are pursuing are aimed at not only achieving a stable and sustainable growth, but also an inclusive one, where everybody has a stake in the growth process of the economy. The kind of economic growth which benefits all segments of society. On the part of the central bank, we continue to be committed to support the overall goal of the government to promote inclusive growth and social equity through ensuring price and financial stability and advocating further financial inclusion. So I have my takeaway message here. The 79 consecutive quarters of sustained economic growth, that we continue to be one of the fastest growing, that we will continue to pursue infrastructure and reform agenda to achieve high and inclusive and sustainable growth. And we have sufficient domestic, even external sources of resilience. And